dashboards and everything else like that I'm sharing. So that will be one of the main things that we'll have on the capital flows dashboard and everything like that. So we'll have all of that out and everything. And then James should be on here.
I'm here.
Greetings.
What's up, guys?
All right. Well, the title, I want to start with going over price action a little bit, but the title that I have for the stream today really sets up for where we're at as it relates to FOMC tomorrow. And I think that everyone is kind of aware that we're not going to have a cut tomorrow. That's all known, priced in, all expected. The bigger question that exists that is going to be the focus of anyone that's trading interest rates or any of the equity traders that are going to unwind hedges, anyone who's actually moving Bitcoin or any other assets around in size, is all about how many cuts are we going to get this year and how the Fed is analyzing inflation. You know, there was actually an article, and let me see if I can pull it up, that came out where this really synthesizes how everyone is thinking about the FOMC projection and the forecast for rates. And let me find... The idea, and I covered this partially yesterday, was that this regime that we're in right now, let me switch this. This regime that we're in right now is one where stocks are down, rates are up, dollar is up on over the last 5 days on a rate of change basis for vol adjusted returns and things like that. And the idea here is that the Fed needs to analyze. You always need to think about how is the Fed going to analyze these data points moving forward, right? And the idea behind it is that they need to make a decision about how they're going to view inflation because their actions itself will have an input into inflation. And so when you look at where we're pricing cuts, the Fed would look at this and say, okay, we're pricing 42 bips of cuts for this cycle. That means that between now and the end of the cutting cycle, the market is saying that the Fed is going to cut 42 bips. And then you have, okay, well, they're going to cut 42 bips, but when are they going to do that? How fast are they going to do that? And right now, the Z6 contract is back to 25 bips in cuts. And you can see that right here when we're at 20 bips of cuts. And if we just have, same idea here, if you have Fed funds, basically 22 bips, there's a little bit of a basis in there, but not a big deal. We have one cut functionally priced for this year. And the Fed needs to give us clarity about how many cuts should be priced total in the forward curve. Because what you can see here is between 2026, all these white contracts, and 2027, the deepest amount of cuts is right here in the Z7 contract, which just means between now and that period of time, we are the market is pricing right here in like Z7, roughly 45 bips of cuts. And the implication of that is how, if the Fed looks at this and says, okay, well, I want the market to price more cuts in the entire cycle between now and terminal, which just means the end of the cycle. Because right here, you have basically the market pricing cuts all the way to the end of 2027. And then after that, all hikes into 2030. Because the market views growth and inflation to be a little bit higher right now. So it's only a couple cuts. And then if you have, growth begin to deteriorate more, it would price more cuts and maybe, more cuts back here, depending on the shape of the curve. And so the Fed is going to have to make a decision because if they come out super hawkish they are going to push real interest rates on the short end higher. Now, it's unlikely that they're going to do that. The way that you can know, and that all of us are thinking about how the Fed is going to adjust rates into this period of time, is all about where we're at with real interest rates. And you can see that real interest rates have come down pretty significantly during this period of time right here. You have 1 year real rates right here that have fallen, which shows that the Fed is, for the 1 and 2 year, the Fed is looking at all these inflation changes over the last couple of weeks and saying, no, we're not going to say anything. We're going to wait a little bit. We're going to see how some of this stuff plays out. But we're not going to say, oh, oil prices are going up, let's start hiking. That's not what the Fed is doing right now. The thing that you want to watch for is how exactly the Fed conducts its forward guidance and how their dot plot begins to move. And so let me pull up the chart side of this. Here's a chart of where we're at in the overall longer term picture for inflation. And this is going to determine, I think, if how the Fed views the changes just took place. Because overall, inflation has just been in this range right here for a while, right? And it has, not really gotten to 2% perfectly, but we made a ton of progress to there. Now we're going to have CPI spike a little bit. And if we look at any of the nowcasts for that, here's CPI, inflation swaps, and every kind of major inflation swap, Cleveland Fed nowcast, Bloomberg Economics, and the BE nowcast. All we're doing with all of these is saying, based on oil prices, food prices, and some other real-time metrics, where should CPI be? Right now, everyone expects it to kind of be around 3.4%. So it's ticking up because of the oil prices. And how high it goes is going to depend on how much of a corner the Fed is pushed into. And so you'll notice that's why everyone is talking about this entire scenario for the Strait of Hormuz, which is, okay, well, if we have crude prices stay at these more elevated levels, if that's what takes place, that is going to take the inflation situation back on this chart right here, and it's going to push it a bit higher. I mean, one of the biggest issues in the system is not just when crude spikes and comes back down, but it's when it bids and stays at that level. Because what happens is that food and energy prices can begin to impact people a little bit, and someone says, okay, well, I have to, go and spend more money on gasoline and food now, and maybe some other inputs in life, and I won't be able to spend as much money on other things, especially discretionary items. So you can have a little bit of shift take place. Now, here is the positive thing that is a little bit of a joke, but the upper K of the economy is not impacted by oil prices. Imagine that. No one in the upper K or in that is more well off even looks at the price of the pump, right? They just go fill up their car and they just keep going. They don't think about it because whether they spend $50 or $80, they don't think about it at all. It doesn't impact them. That could impact all of the rest of the people in the lower income. But you have to remember right now, we have a lot of consumption in the economy skewed toward that, if you want to call it upper K, which is why there's actually, in the same way that, if equity prices drop nowadays, they don't have as much of an impact on growth as they did in the past because so many of the billionaires own the majority of the market. So it has less of an impact on consumption. With that being said, the same kind of idea applies to crude, which is why understanding the context for the regime that we're in right now is going to be critical. And that's really where this dashboard that I built comes in. And if you are not a subscriber on the Substack yet, I'll be sending out a report after the live stream, and I will send you this entire dashboard. So if you are just a subscriber, free subscriber on the Substack, capitalflowsresearch.com. Everything's laid out below. If you want to, click the link, you guys know how it works. Everything's there. I'll send you a breakdown of this entire chart. And I want to walk you through this chart, and then we're going to connect it to markets. And James and I will kind of talk through what would it look like to think through the regime that we're in. Why would that exist in the way it is? And how do you begin to think about FOMC tomorrow, what the Fed could or couldn't do? How would that impact price actions given the premiums that we have in markets right now with crude, the dollar, with cross asset class vol, and the hedges that are likely to unwind tomorrow? Because, there's obviously already a lot of hedges put on from Friday that people put on. And I think the fact that you had equities bid on Monday and Tuesday is an indication of that, right? Just because everyone got so conservative into the weekend, rightly so, I think, which actually kind of funny. I mean, we'll talk about this, but James talked about last Friday, actually, how, because of the changes that took place, it actually be interesting kind of play to be long equities over the weekend because of the defensiveness people are taking that was probably a little over extrapolated. But we'll go over that in a moment. On this dashboard, all we're looking at is the period of time where we have credit spreads right here in blue, and then you have inflation swaps in orange. And these are showing the market's pricing of growth and inflation. So in blue, when credit spreads are rising, that means there's some type of growth risk or credit risk in the economy. There's some type of indication that's saying, hey, we need to pull back our exposure because earnings could shift pretty significantly. On the other side of that, you have inflation swaps that are pricing the inflation risk in the economy. And you will notice that there are a lot of different periods of time where these can accelerate and decelerate. And so what you want to do is net out how they work, because here is the four regimes that you can be in. The regime, you can say quadrant or quads or whatever regime setup that you have, where you have reflation, which is credit spreads falling and inflation rising. So growth and inflation are rising at the same time, spreads are falling. Goldilocks, which growth is positive and inflation is actually falling. This is usually the best time for risk assets. That happened, for example, during a couple different periods of time, like right here when we have credit spreads fall and, this entire period of 2025 that we were talking about last year when inflation expectations were falling and credit spreads were falling at the same time right here was one of the reasons I was so aggressively long during that time. And so that's, really key to identify. And then recession is obviously when you have spreads rising and inflation falling. That's basically like this right here. Some type of growth impulse where inflation expectations are falling and credit spreads are rising. Basically, equities are selling off and bonds are bidding. So these changes in growth, inflation connect to credit spreads and inflation expectations. This is, when we talk about these four regimes right here, a lot of people are only using economic data to nowcast them or to do whatever, which is helpful if you know how to connect the nowcasts to these, but they're not helpful if you can't connect it to the market. So if you just have a regime dashboard on its own and you don't connect it to just the time series and run a basic regression and sensitivity analysis to the actual impact in the market, you could say that we're in reflation or stagflation. And there's even more stuff you have to overlay to get it to actually monetize the returns and trade the market based off of it. But the changes that you see in economic data, for example, if we go back to the dashboard that I talked about, and I'll be, again, if anyone is watching this, I'll be sending more outputs from this dashboard over the next week or so as I'm, finishing building a lot of stuff on it. But, you have CPI model right here. I have a PCE model that's also showing kind of where we're at, PPI model. These are all monthly data prints, right? And so you have monthly data prints, and then you also have the growth data that's also monthly data prints. And people will say, oh, it's lagging economic data, so it doesn't matter. I'll guarantee you that anyone that you ever hear kind of like coming out and saying that is probably not taking risk, because every single one of these numbers, they always move the market. So if you have something moving the market, it's probably an important data point that people are using for their decision making. And so you'll notice right here on the NFP side, non-farm payrolls, that we have this has been trending down for this period of time. And then we had a negative month over month print in NFP. On a 3-month basis, we've kind of been chopping around and kind of flat. And the idea here is that we have a little bit of growth risk in the labor market, but it's not funneling through to every single thing, because we still have things like industrial production pretty strong right now, right? When you have, these, 3-month rate of change right here, it's still positive. And you have the industrial production actually kind of ticking up from these lows and the rate of changes to the upside. All of those are indications that people are still producing. And then you just have nominal spending as well, which again is still significantly higher than some type of recession where we're, at 1%. Right now we're at 5% for nominal growth, right? And, in terms of real spending, very, we're closer, we're at 2% growth. Here's kind of in 2008 when we were at, going negative in August of 2008. Once that starts turning negative and you start having significant issues, that's when you want to be concerned. We're not there yet, but we're closer to it, right? And so those are the type of monthly data metrics. And then those are the ones that you want to connect to these types of changes. And so those, if you can draw that connection as a trader, it's actually super valuable because you can know where we're at. And so here is a chart of the rate of change, simply put, just the rate of change in inflation swaps, the rate of change in credit spreads. And you can see how these periods of time are, incredibly important for where we're at in the growth cycle. And so you can see right here, in terms of the red regime, stagflation, we're in this regime right now, which is causing a little bit of concern for people. Now, this is a very short-term regime, and it's been driven by oil prices, which is why the Fed is going to have to make a decision about how they're going to interact with supply changes in oil prices and things like that. Now, the other couple of charts I want to walk through, here's another really interesting chart on the supply and demand side for oil. You can tell right here on the supply side, we've had a supply contribution that and demand contribution, but a lot of the drivers have been a geopolitical risk premium. And I like kind of seeing charts like this where you can kind of see what the different attribution and drivers are, because we're still seeing, overall the demand for crude in the market accelerate. If that was decelerating, then I would be concerned about recession, growth in the economy, or things along those lines. And so where we're at right now is that inflation expectations are high. They've accelerated on a marginal basis over the last couple of weeks. That has also overlapped with credit spreads rising. You can see that right here. And now the question is, from right here, are we going to move back over, or is this regime going to be for a long time? For example, if we look at, we'll go back to 2020 here, and we will, let's do 2023. Oh, here we go. You can see here in 2022, and let me actually increase the look back so this makes a little bit more sense. Notice here during this period of time in 2022, this is really what happened, where you had inflation positive, and then you had credit spreads positive in 2022. That's, that occurred for an entire year, which is why we had the bear market in 2022. Now you can see that this took a long time to really come together and to persist. That is honestly, this is what people are comparing what we're about to move into right now. I don't think that's going to happen. A lot of people are saying, hey, this is 2022 all over again. Inflation expectations are going to really come in, push things around. And what's actually happening is people are saying, as we move into FOMC tomorrow, hey, if the Fed looks through inflate or these crude prices, then that's going to cause even more of an issue because they should actually be hiking rates right now. A lot of people are saying, oh, the Fed should be hiking rates because we have higher crude prices or something like that. Now, here's the problem with that. Do you realize that if you were going to say, oh, well, we're moving into 2022 right now, and we're going to have an inflationary bear market, and unless the Fed hikes, we're going to have a massive problem. Just think about what the issue with that is. The first one is the fact that for CPI, we have a pretty significant spread and discontinuity between 2022. I'm trying to pull up this chart right here where this. Okay, you can see here during 2022, when we were moving up into 2021 and 2022, we were already at, in 2021, a 6% headline number for inflation before we even had the Fed starting to hike. You see that the difference of where we're at? And then in core, in 2021, again, all before the Fed started hiking, we were at 4% for core CPI. We're now at 2.5%. So this idea that, oh, well, you know, this move tomorrow as we move into the Fed meeting means that the Fed needs to start hiking because inflation is rising and we have this massive issue on the supply side and this is going to be just like 2022. Do you realize how that's just overlooking the entire point about where we're at in the level of inflation, especially for core CPI? Because headline CPI, we all know that's going to rise a little bit. It's probably going to go up. If you look at the CPI swaps for the path forward right here, the market is pricing us to move up to 3.5 from 2.4. So the market is saying, hey, CPI is going to increase 100 bips, which is it's substantial. It's why, you know, if you have 100 bips put into CPI overnight, right, or really fast when you have like an oil shock, then it's very possible to have a little bit of an adjustment in the positioning of the market. But do you see why when we look at the level of CPI back over here in 2021, before the Fed even started hiking, they were massively offsides in where they were. And I'll even show you back in 2021, if we look at the 1-year real interest rates, this entire period of 2021, 1-year real interest rates were actually negative the entire time. Let's see if we can pull up. Let's see.
While you do that, can I ask you a question?
Yeah, please. This is a little glitchy right now.
Yeah. I feel like there's this large disconnect between 95% of people that pay attention to anything macro and real interest rates, right? Like, I feel like you give me the vibe that real interest rates are really the heavy hitter, the thing that really makes the most impact. Yet nobody really talks about real interest rates. It's all about just like the Fed funds rate and like prices and or cuts and fucking pauses and whatever. How do you think we should best think about real interest rates as we like map through these regimes and stuff? Like people who aren't paying attention enough to them, like how do you think we should first approach them?
I think the real interest rates are one of the largest drivers of macro liquidity. in the system. They're one of the largest drivers of FX flows too. I'll actually be having some FX models that I put out soon. If you're really involved in the FX market, it'll probably be one of the most important tools that you can have. I'll hopefully have them out sometime this week. And the way that I think about real interest rates is, and you know what, I think to show this, real interest rates are all about the real purchasing power of money, of nominal rates and money relative to inflation expectations. And I really want to, I'm going to build this chart in Bloomberg really fast, just because I do think, I mean, I'm honestly surprised that more people don't talk about real interest rates, because every single day when I wake up, I look at, well, I actually look at this dashboard right here now. I had all of this in Bloomberg previously, but now I just have it all in here because this is actually so much better. But I look at where nominal and real interest rates and inflation expectations are across every single metric. So for example, I look at here's where we are in every single curve. Here's nominal curves, inflation swap curves, and real rate curves. And I'm looking at what is the shape of the curve across everything and what's happening and why is it happening. And I basically have like, AI agents now synthesizing everything and saying, oh, here's what the transitions are likely to be. Why is it taking place? How to think about that from multiple time horizons, right? Things like that. But the idea behind real interest rates, I'm pulling up this chart right here on Bloomberg. There we go. The idea behind real interest rates is all about saying what is the price of money relative to the quantity of money in the system. So for example, we have here, in white, nominal interest rates. So if you were going to go get a mortgage or some type of other thing that is connected to debt in the system, or if you're the Fed or anyone that's trading interest rates, you really care about nominal interest rates, because that is going to determine the amount of money you have to pay to use someone else's debt. That's nominal interest rates right here. The thing that people look at less is, well, why is a nominal interest rate 3.6%, right? And I'm actually, the funny thing is, if this entire kind of revolution, if you want to call it that, that's taken place over the last couple of years, where people are kind of questioning money and saying, oh, well, the denominator of money is changing, or these things are changing, or, this is the reason for all of our problems in the system. It's the denominator of money. Interest rates are the price that you pay to use someone else's money. And inflation is about, well, how much money is in the system. Because when you have, this is an inflation swap that's pricing where are we going to be at in CPI in 2 years. So the market is saying, and these are just free markets. These are not like manipulated markets that people are coming up with or something like that. These are all free markets. And the market is saying that over the next couple of years, we're going to have a 2% roughly inflation rate. 2.7, 3%. When we're at the highs right here, is 5. And that's on a broad basis, kind of for everything in the underlying economy. And what I would also say is that this is all about the linchpin for everything. So if these are short end rates. So these are kind of the asymmetrical linchpin on which the kind of entire door of the economy turn. And so if these change by 20 bips, 50 bips, that reverberates across the entire economy, because it controls the supply of money for the entire economy. And so the Fed is always looking at this spread right here between inflation expectations and nominal interest rates. So, for example, during this period of time right here in 2021, when you had inflation expectations rising, you had more money in the underlying economy. That's all that is. It's like very simple. It's just money in the underlying economy rising relative to the amount of goods and services that exist. When you have inflation expectations rising like this, if you don't take up the price of money too, what do all of us do? We all say, hey, right now, the ability to get a mortgage rate at 2.5% as home prices are going up is really cheap. We should all go buy houses and, be able to lock in a low interest rate. And that was this entire period of time because real interest rates were negative. And the fact that, you have a mortgage rate locked in at a low interest rate, and now your income has probably jumped up since then, or you're making more money, hopefully, since that period of time, is an indication about how real interest rates impact things. And so when the Fed has nominal interest rates below inflation expectations right here, it is allowing more money to push into the system because it's taking the price of money, nominal interest rates, and it's bringing it below the amount of money in the system, which are inflation swaps. I'm talking a little broadly about this because there's some qualifications and there's like some minor tracking errors and some other little kind of like things for how is inflation distributed in the system and all this other stuff. But broadly speaking, those statements are correct. And so in this period of time, when you have inflation, it accelerated so much, and then you had the Fed say, okay, we need to pull inflation down. What did they do? They took nominal interest rates and they pushed them up above inflation expectations. And then as they push them above inflation expectations, now when you have to borrow money above the rate of inflation, then now you have to actually pay more money in real terms. So your income is rising less every year relative to the debt service costs that you're paying to take that out. And the reason why it's hard to understand and it's not as intuitive is because we all think in nominal terms. I'm paying $5,000 for a mortgage. I'm paying $10,000 for a mortgage. I'm paying $500 for a car payment. I'm paying this amount for this. The S&P 500 is at this number. None of us think about things in terms of real purchasing power, really, in our nominal world. Every interest rate trader out there, though, the main thing that they care about is the relationship between nominal changes and real changes. Because if you understand the relationship between those, then you will begin to understand why the curve is doing what it's doing and how that impacts macro liquidity. So now we're in a period of time where, inflation, we have nominal interest rates above inflation expectations, but now because growth is still positive over the last couple of, period of time, then, and this is now kind of what's making it even harder to understand is that if we, zoom into these shorter term changes, all of these, you can say, okay, well, yeah, real interest rates are positive, but these moves right here are on the margin, right? When this spread right here narrows or widens right here relative to amount of growth in the economy, that is what determines if equities are rising, or it's one of the inputs into whether equities are rising and falling. So, for example, this entire period of time right here, when real interest rates were falling after the tariff drawdown, and then you had it kind of like consolidate a little bit, and then you were kind of moving around a little bit. Now we're kind of moving back down. This is injecting on a real purchasing power basis liquidity into the system on a real purchasing power basis, which is actually happening right now. But the thing is, because the questions around the Fed and the positioning risk that exists right now in not only S&P but other things, that's why we actually still have equities down, and why they're compressing likely before we have some type of rally. But when I see real interest rates moving over like this, and again, this is on the short end. You also have to kind of look at it on the long end as well. But when that's taking place, then that helps me understand, okay, when I look at the S&P here, and I'm trying to pull up the vol chart of the S&P right here so that, and we talked about this Friday and yesterday about, hey, we're probably going to have the S&P bid a little bit because of the amount of hedges that are in the system right now between, just from positioning. Here is S&P 500, and you have your put skew right here in red, which is people bidding up puts. You have implied vol rising on an outright basis, and then puts getting a higher premium than calls. Now, we kind of made that bottom when we blew out, and now we've been moving up as these hedges unwind. And now as we're moving into FOMC, we're going to see if those hedges can unwind even more. I think they will, especially by Thursday and Friday, as long as crude doesn't make a new high here, which is pretty consequential. If crude doesn't make a new high here and we move through FOMC, and also you have, where is it? Euro USD continue to bid up, which I think is going to happen. I think Euro USD has probably made a bottom here, and we're likely to just start bidding right here as the dollar begins to weaken, which if you were on the website and you went to the crowded trade thing and you went through the recent report that I wrote right here, talking about, the chart crystallizes how this positioning is cross-collateralized, which means that, where is this right here? That this is likely to produce equity buying and dollar selling. And that was the view that I had as you kind of have this regime fade because of how much positioning you have in it. And that connects to real interest rates, in my view. So you have, if real interest rates begin to roll over a bit more as that positioning unwinds through FOMC, you could see kind of this massive move down in the dollar right here and begin to break to new lows again, which my view is that, the dollar is likely, the administration and everyone, and where we're at with rates, the dollar is likely to move lower in my view, which will actually probably bring merit to gold and silver right here. I think that if we get some geopolitical, and I think I already said this on the stream yesterday, if there's some news that says, hey, the Iran situation is over or whatever, de-escalating, and these wick down, I would just be buying a ton right here for a break to all-time highs with, stops probably down here, especially if there's like this fast wick where it's like, oh, geopolitical risk flush. But then everyone goes, oh, wait, but the dollar's going down now. Now we need to bid this, and we're going to make a new all-time high. Especially, here's the wild thing on gold and silver right now. And let me pull up this chart. All of the vol in gold and silver has come down just so much.
Yep.
So that was probably a long explanation for everything, but
no, I mean, I just like put all that together, and I'm just like, the real interest rates starting to roll over to the downside, and then this idea of like the put call skew, and like everything feels like you got the OPEX, you got FOMC, you got end of quarter, like all these things seem defensively positioned to the point where it's just like more and more and more tinder for a violent upward move that not many people would expect. And like you add in like, I know it's a probability curve of like escalation or de-escalation, but like you have to kind of lean on the side of like de-escalation at this point.
Totally.
Given all we've been through. And I'm like, man, it's really hard to bet. Like it's at this point, it's just hard for me to find a short at that point. And to add on to that a little bit, it's like, oh, and the vols. But I was thinking like, all right, well, if that's the case, and you were like, you're some viewer out there, and you're like, how could I express that? Like, we've talked a lot about how you can go down all the way down to the knife's edge of risk, but like, you got to incorporate your time horizon too. So somebody might feel more comfortable like, hey, I want to be, let's just say they were bullish off this, right? And I want to be allocating here. If it's for something that's longer term, they might not want to go all the way out to a per type of thesis. They might want to just like buy this S&P. But if their time horizon goes down to like, hey, I just want to do a post FOMC scalp for the rest of the week, then maybe it's like you go all the way out that curve to the most violently repriceable thing. Does that make sense?
Totally. Yeah, I think that the entire setup right now is that there was a lot of premium priced, and if we move into an inflationary bear market, it's very likely after we unwind the positioning for it. So it's people are like, oh, we're gonna have an inflationary bear market, maybe, but first, this goes back to like the path. First, we need to wash out the positioning that believes that's going to take place in the next week. Right. So this goes back to, I just feel like the entire path, the path and destination thing, and why you need to align yourself with both, which is why, quote unquote, investors are all about, well, where are we going? How do I take a big bet on the ultimate destination? And why, if you're a trader and you can understand the path, if we get overly aggressive or underappreciate and discount the path, then you can have a pretty significant opportunity to extract additional returns along that way, especially when you stack these metrics of like, I mean, this setup right here is wild to me, that we have, you had skew blow out right here in red for gold at the highs. So call skew is blowing out. And then you kind of had the same thing right here when we made this other move up. But then now vol has just been collapsing in gold. And when that happens, that just tells me that all of the people that bought a bunch of calls, and especially if we're just in this range right here and we're not actually like collapsing back down to 4,000, the fact that we're just chopping in this small range and vol was so elevated, it just tells me that every single person who bought calls or puts, because things aren't happening as fast as they wanted them to, they now have to sell all of those, or else they're going to lose a ton of money. So they're saying, oh, now I bought, the guy who bought calls up here is saying, I need to get rid of those because it's not going to happen this month, which it's probably not. It would take 2 months probably. And he says, okay, I need to like take those off and wait to re-enter. And then the guy who bought puts at 4,000 or 4,500, we've moved down a little bit, but not a ton. And now he's saying, okay, we're probably not going to move down to 4,500 in the next month. Let me just take it off and wait. And that's literally hedging pressure that's all hedging pressure is. Everyone likes to overcomplicate it. That's all it is.
Yeah, that's actually pretty fascinating. It's like pinning it between the bulls and the bears, right? And just annihilating all of the options, like ability to make money.
Oh yeah.
Oh, that's hilarious. And then the fact that you said that, like, let's say now you're a bear. If you have like this scenario play out where you're right, like maybe the destination is a inflationary bear market or whatever. If you do think that along that path, there's this unwinding of positioning first, ironically, it might be best for a bear to take the most aggressive long here that you possibly can. Because if you do believe the destination is lower, you need to take advantage of the unwind and positioning with the most aggressive thing, which would be probably the hardest thing for a bear to do, which is hilarious.
Totally. Yeah. I think this is one of the reasons why I never fear missing out on a trade. And I feel like I've gotten better at this over the years, where if I have a really good idea about how to map the path of something, right? Like in, these moves in either direction, and just saying like, okay, can I have some type of insight, not just to say, okay, Bitcoin is probably going to be at $1 million in whatever period of time, and say, okay, maybe we'll be up here by 2035. No, I'm just kidding. We'll move forward. We'll move closer.
Don't even get me into that.
We'll give you 2030. We'll say 2030. is $1 million. Is that, or do you want it closer, James?
Whenever Kamala is president, that's when we'll get it.
That's honestly probably true. Um, but I've never worried about it, just because my view has always been, if I can know the path and where the extremes in the path are, then all I need to do is find the extremes and get on sides there. And then try to constantly get on sides at some type of on the path that exists toward this ultimate melt up or a destination or whatever it might be. As long as I can use the path to get on sides there, then I can like manage my risk a lot better. And I think that's something that I think if you get better at as a long-term trader, you will save so much money and you will limit so many more drawdowns if you can align yourself with the path on the destination to a melt up or meltdown or whatever it might be.
Yeah, and to couple with that, time in the seat allows you to realize one thing I've learned, especially after this past year with the AI, everything, is that you will have those opportunities along the path. Like literally no technology has not gone through a trough of like disillusionment, right? Like getting back to that Gardner hype cycle. Yep. It's like we've seen so many different things over the past 5 years, 8 years. I've been trading since 2013. Literally everything there's never been one asset that runs away so fast that you don't get an opportunity for a really good buy multiple times. And Bitcoin's a perfect example of that.
100%.
There's like been so many times where it's like you just feel like you're never going to get the chance again. And it's proven over and over. Everything. I mean, just every single thing. And if you, that helps you in the future when you get a little bit of FOMO.
Well, this is a perfect example, honestly, for Hyperliquid right here, because I know a lot of people are saying like, oh, well, and I talked about Hyperliquid and Per, and I know we've both been long for a while and, bullish. But the entire idea behind this, and this is like, this goes back to us having realistic expectations about the future, right? Like we both know that, like, listen, you're probably not going to execute perfectly on the trade. You're probably going to screw it up somehow, and don't think you're going to execute perfectly so that you can kind of actually hedge your own ignorance a little bit. And then on top of that, like the fact that we have so many of these, like the fact that you in your mind think, all of us think that we're just going to move like straight. We think that this is going to happen. We're afraid of this, right? And that happens. When in reality, it's probably going to be like, oh, wait, we're just here for a while.
Are you sharing a screen? We can't see it if so.
Oh, you're right. Sorry, I was drawing this entire time. But I think the entire...
Is that a Stegosaurus, bro? I don't know what kind of stuff you're doing, but that looked like a Stegosaurus. Capital flows. It's the dinosaur guy.
Let's draw a dinosaur. I think all of us think that like we're just going to go like straight up, and we're afraid of missing out on it, right? So we're like, I need to bid right here, and if I don't, I'm screwed. Especially when it takes place like after one of these moves. Whereas like we talked about this earlier off stream, is my entire goal is to say like, okay, like I know that like this is probably potentially at best what a trend could look like to the upside, which is like right here, you're going to get the most amount of fear and trolls like every single time. Right here, you're going to get the most amount of euphoria no matter what. And the most important thing that you can do is not think that you're going to just like, it would be amazing if this trend worked, but you should prepare for this trend, right? And then like what I do is I go through and I say, okay, like let's be realistic about this and say what caused this to move up and what caused this to move down. And I know, okay, well, this was HIP 3. This was markets not trending and a lot less volume going through, but open interest still remained high. And then you still had fees going through, but then you kind of over extrapolated this move a little bit to flush. And there's probably a little positioning that got blown out there. And then you had kind of the beginning of more HIP-3 volume going through, more deviation from Bitcoin, and then you had, okay, now S&P 500, like when this is bidding and S&P is going down, that just tells me that this is actually providing value, more value than the S&P in a relative comparative sense. And then this entire move, the fact that it's rising on geopolitical risk premium is telling me, okay, crude volume, silver, gold, equities, maybe some other things are all going through here right now. And so if the geopolitical, I mean, there's the biggest test that I think about right now is once crude sells off, if Hyperliquid can maintain its bid above these levels, then it's telling me that it's not just dependent on geopolitical risk spiking. Because it's very possible. Let's just say, theoretical scenario. Geopolitical risk gets nuked. Crude goes down 20%. And then Hyperliquid begins to trade down because it's like, oh, well, there's not as much vol in the market. None of these crazy moves are happening. We could begin to sell it down a little bit in Hyperliquid, right? If that took place, I would begin to say, okay, that's possible, but I would expect us to stay above these levels right here, right? The way that we could keep on bidding is if, as crude volume decreases in Hyperliquid, other assets begin to take the market share, the share that crude was originally having in the entire setup, which is why I'm watching the HIP-3 volume right now so carefully, because in this tab, if you're watching, you can watch all the HIP-3 and you can watch a byproduct and say, okay, how much is going through crude, Brent oil, silver? Because if this goes down, right, and the funding rate changes and all this other stuff, right, then that I want to watch how those other factors begin to play into it, right? And if they can kind of take the reins and take the baton from crude volume, if that makes sense. And that will begin to shape how I think about the trend right here. And I actually wanted to pull up, I didn't pull this up earlier. I wanted to share this with everyone.
Keep going. I'm going to run to the bathroom.
All right. This is great article that was just recently published on Hyperliquid, that Hyperliquid is taking the CME, not Binance. Now, I think there's an element of salt that you need to take with this. A little bit of salt you need to take with this. A pinch of salt, if that's the phrase. But I do think there's an element of truth to it. Hyperliquid, when you think about the entire idea that I laid out on my Substack about it's taking the establishment where everyone thought, oh, we just need to get crypto to trad markets so that people can pump our bags, instead of how do we create so much value that trad markets come to crypto. And that's what Hyperliquid is doing. When you do that, then the entire question is, how should we compare Hyperliquid to traditional markets, to things like the CME? And this article did a great job at breaking it down. You can go through this if you just search this on Twitter, published March 13th. The CME generated $6.5 billion in revenue in 2025, with 28 million contracts traded daily, market capitalization of $114 billion. Hyperliquid earned $960 million in revenue in 2025 on $3 trillion in trading volume, with 12 billion market cap. Hyperliquid now generates about 15% of CME's revenue, but is valued at just 10% of the market cap. The key opportunity is the extent to which traditional financial volume can move to decentralized platforms like Hyperliquid. So from DEX to Global Derivatives Exchange, Hyperliquid HIP-3 launched in October 2025. It goes over kind of these ideas about HIP-3, perps. One of the things that I was talking with James about before stream was about how exactly perps change the game. And HIP-3 in itself, when you have it beginning to take more and more market share, right? And then you have the Iran war functioning as a proof of concept. Everyone on Hyperliquid and everywhere else is beginning to realize the Iran war is kind of like a test case for how much crazy stuff can happen, and Hyperliquid provides value. On February 28th, the U.S. and Israel attack or struck Iran when traditional markets were closed. Within hours, oil-linked perps on Hyperliquid surged 5%. So traders priced in the shock in real time. By the following weekend, after WTI posted its largest weekly gain since 1983, oil perps on Hyperliquid recorded over 1.2 billion in 24-hour volume and 40 million in liquidations. Cumulative crude perp volume went from 200 million to 6 billion in 2 weeks. Bitcoin flattened near this. The macro trade was happening on Hyperliquid, not on spot crypto, which just shows from 200 million over a 6x, right? Like that's almost a 12x. From 200 million to 6 billion in 2 weeks is massive. Here's trading oil, XYZ's perp volume. I mean, this is just so large in how much all of this has changed. I mean, the fact that they got crude perps on there right before the attack is huge. On CME's total daily volume across all assets is 3.8 trillion, excluding interest rate products, which are structurally complex and unlikely to migrate soon, which actually one of the things that James and I have talked about, and we've talked about even with some of these guys at YXZ, is that if you add interest rate derivatives, that will be likely the largest edge that Hyperliquid has. These are Hyperliquid already dominates in the CME volume in equity indices, energy, metal, agriculture, FX is approximately 1.2 trillion a day. You have the CME benchmarks and they compare it, and then goes through scenario analysis. And I think these were helpful as a baseline. The idea is, I agree with this, and I think that Hyperliquid, HIP3 needs an equity index and commodity perps to hold volume after the novelty fades. And the 0DTE crowd needs a reason to move from options to perps beyond lower fees alone. So if you have all of this HIP4 stuff launched on perps so that you have 0DTE options on Hyperliquid through HIP4, and that goes on top of HIP3, and all the fees for that are lower than the CME or anything like that, that could be just an absolute game changer, because everyone says, okay, now I want to put all my money on Hyperliquid to trade instead of in my brokerage account. So that could be massive. So I think that was a very interesting article. And then this other article, The Great Perpification, by Ryan Watkins, cool account. And he goes over how exactly to think about this entire progress of perpetuals. And you have this, great perpetualization. And I think that one of the things that is misunderstood still about perps is here's perp volume or DEX between DEX and centralized exchanges, and then perpetual HIP3 volume has exploded here. One of the things that I think about for perpetuals is the idea that, if you think about futures right now, all of us who trade futures, when we trade them, at the end of the day, we have to sell them so that the contract doesn't expire, right? And we have to incur a taxable liability to be able to have that. Perps, on the other hand, if you just hold that, you can actually hold that and just pay the funding rate, and almost like using margin on a stock, except you actually have future size volume. And now you can actually reduce your taxable liability in many ways. Especially if you get a trade that's on size and you say, oh, let me just hold this for a year to have a long-term cap gain instead of a short-term one. I think that's kind of an interesting thing. I'd be curious, James, do you have any thoughts on that? But I think that's actually a thing that needs to be taken into account for the return kind of analysis for fees and things like that.
Yeah, I'm not sure. I haven't thought deeply enough about the like marginal benefits like that. I do just know that nobody really thinks. Well, first of all, there's a big segment of not only crypto, but just like, I mean, most normal people that have never actually executed a perp trade, right? I mean, in the grand scheme of things, they're pretty new.
Right.
So, like, my personal experience with making a perp trade has been like, holy shit, like, this is so much simpler and makes intuitive sense. And like, it just flows well. Whereas, like, setting up a futures account, you got to get approved, you got to pay round turn costs that could be extremely high and counterintuitive to like what you're actually trading. And like, the fact that if once all of these get brought onto these dexes and sex, I don't know if they'll be brought on centralized ones as well, but like, I assume at some point, if anything pops off, like if this just goes to show you, like, it could get brought on chain or onto these things and just instantly liquidity can move there. Like silver went from not existing on Hyperliquid to trading like 2% of all 2% of all like notional or whatever in like a week, 2 weeks. I don't even know what it was. It was crazy. But like, that could happen in the Tellier, that could happen in the yen, that could happen in soybeans, that could happen in any random stock that goes into an absolute bubble. Like, it could be brought on, perpified, and traded like crazy. So, right. I mean, just imagine if you had another run of like a 2021 style broad market rise, and then you had the top 200 stocks, 100 different, all the cryptos, all the commodities, all the interest rates, all the currencies, all available to trade, and you went through one of those moments. Imagine the numbers.
Yep.
You know what I mean? Oh, and if it was allowed in America. Just imagine the numbers. It would be unbelievable.
Well, this is actually probably be a great point to kind of pull things together and end. But this is the tweet that I shared the other day. Let me find it. Here we go. I think. Okay. So here, this was the tweet that I shared yesterday, and I shared several thoughts. And I started with, we're moving in lockstep with the view I laid out. Pin tweet, I'm long per, everyone knows that. The idea that TradFi assets migrating to Hyperliquid are creating an uncorrelated source of returns that is causing Hyperliquid to diverge from Bitcoin. This is happening. I laid that out before it actually happened, right? We did multiple streams and videos on that idea. This is happening perfectly as HIP-3 volume becomes a larger percentage of open interest in volume. But this isn't all that's happening. It would be one thing if hype diverged from Bitcoin, but it also rallied while global equity markets sold off on geopolitical risk. We are literally seeing Hyperliquid benefit from global volatility. It is in many ways exhibiting anti-fragility. The second thing is we are still waiting on Hyperliquid to be integrated into the US regulatory framework. Once this happens, even more flows will come on and arbitrage a lot of the returns so that funding rates collapse. So once it gets added to the US, it's going to have a lot of institutional volume that comes on that is not able to come on right now. And that's going to cause funding rates to collapse because everyone's going to say, oh, I can provide leverage and make a yield. Once funding rates for leverage on perps collapse, even more traders will be incentivized to enter the platform and get institutional level leverage as a normal person. Soon enough, you'll have the same Israel level leverage as Chamath. Third, we have already seen many firms file for the Hype ETFs, but we're still waiting on approval. In this interim period of time that people are going to be aggressively chasing exposure in Hype, in the Hype token, but won't be able to obtain it until the ETF launches. In this window of time, PER is likely to rally the most because it's the way for larger players to get exposure since they hold the most tokens of any DAT for traders to get size on. If options are listed on PER, then this would likely create a massive gamma squeeze. Here's the wild thing. If they get volume to start trading on Hyperliquid so that perps and options are trading on Hyperliquid, and then at the same time, you have options get listed on PER, like stacking option flow so that it's like this massive thing. That would be, again, another kind of like, there's just so many things that could stack up and be insane, right? This is why Per stock is my largest position right now. I did an interview with the CEO. That's all linked below, guys. Finally, what seems to elude most people is how agentic trading for both systematic and discretionary traders is going to dominate and be the primary place it is going to be on Hyperliquid. So, I've talked with a lot of people about agentic trading and the agentic models they're building. And if you think about the vaults that get created where everyone says, hey, I have this new thing. Hey, do you want to invest in my Polymarket account where I'm betting on all of this stuff? And you say, oh, wow, this guy has an AI agent that maps every single betting market, except all the betting markets kind of migrate to Hyperliquid instead of Polymarket and Kalshi because those guys are sharks. Like that would be like huge because then you could have whatever AI agents running everything and finding all the different like bets and opportunities, and you can create an entire vault around it. I suspect that the adoption will overlap at some time with greater memory options that are released with AI, which I still think is like, they just released a little bit more, I think, over the last 2 weeks. When you have more memory, you're able to have more informed iteration, much of this with a massive amount of compute to fuel it. And you have a scenario for one of the largest productivity booms and liquidity injections in history. This doesn't account for the possibility, it's very possible actually, of tokenization laws to pass where you can legally tokenize real-world assets on-chain. Right now, that's illegal in the United States. The upside is always inconceivable in foresight, but obvious in retrospect. My entire goal, and James and I have talked about this, is that I'm trying to focus more on agentic trading, agentic macro, why it matters, and how to constantly pull together every single thing that I've done so that my focus is on that. Because I think that's the greatest bet that you can take. And you don't want to just take it by saying, okay, let me be long Hyperliquid. Figure out how can I be long Hyperliquid, and also being able to figure out this AI stuff, and also figure out how those can merge together, and stacking all of these edges and differentiations on top of each other so that you can kind of have this ability that takes multiple forms of leverage and gets them in a flywheel effect so that you can really have a game changer output for all the bets that you're taking. So that's my view. That's why I've shifted a lot of the Substack to say, I'm really focusing on all of this agentic macro, agentic analysis, and I'm going to be sharing a lot more of that. I'm going to be sharing the FX models and some other stuff this week. And then I shared this at the beginning, if you guys didn't get it, or I'll be sharing this. I shared this where I talked about this entire dashboard, and I'll put the last 10 years and rate of change. Here's a dashboard that kind of maps where we're at on a rate of change basis. If you want to understand where we're at in the macro regime and say, okay, how do oil prices, how do inflation swaps and things like that impact where we're at? And it maps all these regimes. I'll be sending this PDF out in the report that I sent out today. So if you want that, I'll send it out to everyone. It'll all be free. Go to capitalflowsresearch.com. You guys know where all the links are. It's everything's everywhere. I'll be sending out more stuff like that, and then also integrating a lot more of these agentic things. And then I'll be sharing a lot of Claude Code stuff as well that pulls together all these moving parts. So if you guys are here and you want to continue to be a part of all this, become a subscriber on the Substack. Just share the work. I mean, shoot me a message if you guys want. Any of the stuff that you guys share on Twitter, super helpful so that I can continue to put out everything. I really appreciate everyone that always retweets everything. It never goes unnoticed. If you ever have something that you're working on that you're like, this is something that's super sick, I'm trying to learn more and grow the following that I have, or, map these things. Like I just shared, actually, for everyone that's here on the Substack, one of the subscribers who I talk with, Alfie, he built out a lot of TradingView models that are directly linked. Like here are all the models that he built out. All of these models right here, he built with AI, and they're all TradingView models. You can download all of these right now. And he just was like, hey, you taught me, you taught me a lot. You learned a lot from the things. And he pulled together all these models and he just said, hey, we can just send these to all the subscribers because he just wants to help everyone, which is like huge, right? Like that's just being able to give to people like that and share things is just massive. So, and you can go here. You can go follow all of his work right here on the Capital Flows Research website. All the educational primers are right here. Like, just think about where we're going to be in 6 months on this page. Like, there'll probably be a lot of agentic models. There'll probably be a lot of like trading view models. There'll probably be dashboards. If you have anything that you're like, hey, I want to pitch this, I want to share this. I mean, you can go to Liquidation Nation with Jared. All the work that he's doing, like, it's sick. I mean, this entire dashboard that he built is amazing. Like, you guys should go subscribe to that. It's all free. So the amount of stuff that's going to be on here is just going to increase. And if you're someone who's saying, hey, I want to just be involved and learn, and I want to kind of drink from the fire hose, then you can shoot me a DM and be like, hey, I'm trying to think about this or work on this. What do you think I should do? Or if I built this, could you share it with people? And I'll let you know. I'll be like, oh, you know what? That's not that great. You should improve it in this way. Come back in a week after you've built it, and then we'll talk about it. Right? And just grow and improve with all these different things. And then I'm always happy to share anything. If you build something that's like exceptional and you want me to share it with everyone, I'll always, if I think it's actually good, I'll always share it. So that's where I believe we are in the cycle. That's where we're at with Capital Flows. Things are only going to get better up and to the right. So, James, any final thoughts, final words?
No, I thought this was super interesting. I think Alfie, he's in the chat too. I think he made a great comment going back to what you started off with, and that's that the path of the regime is where the edge is, not exactly the regime that we're in. And I feel like often the sentiment and the vibes is people mistracking or leaning too far in one way on the path of the regime, or they're focused on where we are now. So yep. I think where your work really comes into play is like seeing, like, via data and models is seeing where the puck is going. And then we got to figure out if we're biased towards the puck going that way, how do we best express the biggest bet we can? I think that's
totally agreed. Awesome. All right. Well, guys, all the research is laid out. You can follow the work I'm doing at capitalflowsresearch.com. You can follow all the stuff that James is doing on Twitter at his handle. It's on the screen right now. All of his YouTube videos are on his channel. They're all really great resource. And I will be doing another live stream tomorrow, same time. So you guys show up tomorrow, same time. I'll have another live stream going. We'll be covering more on FOMC, the changes that are taking place. And then the next stage will be some more of these agentic models and FX models this week. So with that, I will catch you guys later.